Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending February 25th, 2022. So the week was all about Russia and Ukraine. Markets were volatile. So let's focus on only this topic this week. So as I'm recording this, it is a Friday morning. Markets are not open yet, but we are seeing a more positive tone that we're hearing about talks and a Russian delegation being sent to Ukraine to negotiate. So we'll see how everything turns out. We'll see if the tone remains positive through the day. But on Thursday, we had quite a reversal on the US stock market. So let's go into the details. So first, let's look at this week's markets at the close on the Thursday. So you see a lot of red on the screen. So that means interest rates were still higher on the week, even though we had the pullback in rates on Thursday. We end the week net negative for bonds. Same thing for equities. The TSX still holding together, so kind of outperforming on the upside when you look at in local currency and when you compare to Europe, when you compare to emerging markets. The S&P 500 is now officially in correction territory. That's not the case for the TSX. So now you're going to see maybe a base being formed here for the S&P 500, but we never know where the bottom is. But the negative all across the board, and the most negative index was the emerging market one, because on the Thursday, Russia is a very small part of the emerging market index, but Russia was down more than 30% in one day on the Thursday. So that explains why emerging markets were pretty negative on the week. So overall, the TSX is still leading the pack year to date, but we'll see how the day goes by. So I have no idea how the day will turn, even though we have a positive tone today. So maybe the picture will be very different when it's all said and done. Oil higher on the week. Russia is a big oil exporter, so a risk premium, geopolitical risk premium on the price of oil. When you hear in the media that oil was over $100 on the week, they're talking about the Brent, which is the price index for global oil. Here we always quote the WTI, the West Texas Intermediate, which is the North American price or the US price. So that's why we're at $92 here and not $100. Canadian dollar was down because of the risk off tone. So when the tone is negative, Canadian dollar tends to pull back a little bit. Euro was down and gold was up. So geopolitics usually rhyme with higher price of gold. So now if we look at the headlines, so the headlines were all over the place. So Russia invades Ukraine, US and UK, and well, the West is rolling out sanctions on Russia. Mr. Biden has been very clear with his sanctions, and he wants to hammer Russia's economy. China refuses to call the Russian attack an invasion. But this morning, just before I started recording, we were hearing China pushing very strongly for resolution of the conflict, being more as a peacemaker between the two. So we'll see where Russia stands. But now it's pretty clear that we have three zones of influence in the world. China with its influence on Asia, Russia with its influence on the Middle East and Eastern Europe, and then you have the Western world. So that's it. That explains a little bit what we're seeing here. We're seeing sanctions, but we're still seeing zones of influence that are getting clearer and clearer. So if we look at the Russian economy now, the economic impact of all of this, first for you out there, for all of us, higher price of oil means that inflation probably is going to be staying bit more vivid than what was expected. Remember that we were expecting, the consensus of economists were expecting, and central banks were expecting a quick pull down of inflation over the second part of this year. We're at 5.1% in Canada now. We could go down all the way to 3% at the end of the year. That's what the Bank of Canada was expecting. So I mentioned that many times in the last few weeks. Now, maybe if the price of oil remains high because of these events, maybe that means that it's going to take a bit longer before inflation pulls down. So that's the most important economic impact for all of you out there. But if we look at the Russian economy, Russia's economy is actually pretty small. It's neck and neck with Canada. So that's the size of the Canadian economy. And remember that there's 150 million Russians compared to 40 million Canadians. So GDP per capita in Russia is actually pretty small on an international basis. So it's not that it's a economic juggernaut. It has military power, of course, but the economic impact is more on what Russia produces and sells on the market. So here you see that it's the biggest exporter by far of palladium and also platinum. So platinum is also pretty strong. That means that those are rare earth metals. So they go into the production of computers, of iPhones, of electric cars. So I mean, you can have an impact there on the global supply chain if you put some sanctions on Russia on these much needed metals. It's also a big producer of gold and of oil. So if oil remains high, the price of oil remains high, that could mean also that it could be good for the Canadian economy as a whole, because what we export, oil, for example, and other base industrial metals that you see here, agricultural commodities too. Well, we do export some of that, so if the prices are high, that could have a second round effect that is actually positive for the Canadian economy and for the TSX, because remember that the TSX, the metal sector, everything that has to do with commodities is well represented in the TSX. So higher commodity prices could be positive for the TSX down the road. So it could also support the Canadian dollar. So I mean, we don't wish war to happen ever, but if you just look blindly at the economic impacts here, depending on what the sanctions are, we haven't seen sanctions on Russian oil exports so far, but if it goes as far as that, could be a benefit for other commodity producers like Canada. So there could be an opportunity there. Now, if I move back to the markets, historical reaction of markets when we have a geopolitical event that is military of nature. So here we selected a few important ones from the Nazi invasion in Poland in the 1939 to Pearl Harbor, all the way to Crimea in 2014. Well, what we see the pattern here is that heading into the event, so we knew that Russia was putting troops on the border of Ukraine, so we're hearing about that. The markets tend to correct before the event. When the event happens, 1 week after, 1 month after, it's pretty much just to the toss of a coin. So you don't know. So it can be a crapshoot. Where is the bottom? But if you start to look further in the future, well, after 12 months, the markets are up on average 3 times out of 4 with some good returns. All right. So if you have a long-term investment horizon, these events could be beneficial to your portfolios, because you're buying at you could be buying towards you never know exactly where the low is, but it can become a buyable environment. So here in the table here, it tells you that if you have a long-term horizon, it's a good idea to put some money at play. But it does also tell you that it's 3 times out of 4, not 4 times out of 4, that it's higher after 12 months. So there's always risks in the market. So if when you look at your portfolio right now, you look at this table here and you're losing some sleep and you're worried about your savings, then maybe you should sit with your financial advisor and look at your profile again. Maybe you're not as audacious as you thought that you were. So that's one important thing. And also, if you want to time the market, know that even us, with all of the trading desks that we have and the team of hundreds of analysts and certified financial analysts that we have and PMs, timing the lows, timing the highs, it's something that you can't really do. It's too unpredictable. So if you're looking at that, we always say that spending time in the market is the best thing to do, not trying to time the markets. So that's one. And systematic investing, if you want to take the timing out of the equation, saving every single week, 2 weeks, every month, just on a systematic basis, means that you would be buying the lows and you would be buying as the markets go higher. So I would strongly recommend that you give that a look if it's not something that you've done already. So a lot of things here. You remember, investing is all about managing your emotions, making sure that you don't do mistakes and you keep your eyes on the long ball. And here, exactly this table is that I showed is here to remind you that there are some risks in the markets, but those risks tend to shrink if you always keep a long-term perspective. So what to watch next week in Canada? We'll have a real GDP coming out for November. We'll have a rate hike, most likely from the Bank of Canada, even though everything that happened this week, market volatility Russia and Ukraine. We still think the Bank of Canada is going to hike by 25 basis points next Wednesday at 10 a.m. That's the time of the decision. So expect the leading rate to go from 0.25% to 0.50. So that's what we're expecting. In the US, we should have some good economic data coming out, showing some strong momentum again. So that wraps it up for the week. ia.ca/economy, Twitter, LinkedIn. On LinkedIn, you can get the PDF version of this presentation here. You can follow us every single week at this address. So thanks for following us, and I'll be back again next week with another edition of the Weekly Economic Review.